Hello everyone, I welcome you to class. In this video, I am going to be talking about a new concept and a sub-concept in the candle matrix concept. I call this the market cycles. So this would be the first part of the market cycles. Before I proceed, I would love to use this brief moment to appreciate each and every one of you that promoted the previous video. The numbers that we did on the previous video very much surpassed my expectation, and I really appreciate the likes, the shares, the comments, and the promotion. Thank you very much. So, in case you are just seeing this video for the very first time, in case you're just seeing the candle matrix or hearing about it for the very first time, I'd like you to know that there is there is another video just before this one, and that is the first video in the candle matrix public mentorship or the candle matrix playlist in my YouTube channel. Something else that I'd like to add is I really appreciate every of the comments that I got from the previous video, the positive comments and the negative comments as well. I noticed that a number of people, made comments advising me to add chart examples, right, to my teachings, especially the previous video that I made, because when I explained the whole candle counting, I didn't go to the chart to show examples. And trust me, it was very intentional. The reasons are because, number one, it's an introductory course. I didn't want to make it any complicated. And number two, going to the charts and showing you these examples feels like cherry picking. So to you, you might think that I am cherry picking, and I really don't want to give you that impression, because this is a very new concept, and my job is to make you understand that it is a profitable one, and it is a very consistent concept. Candle counting in itself is not enough, right? And I noticed a number of people already applying what I taught in the introductory course. They were already applying it in real markets and in the live markets, and they were already risking their money trading candle counting. Now, there is still a lot that you need to understand to make sense out of this concept, and to also be able to consistently trade candle matrix concept profitably, right? One of these things are the market cycles, and in this video I would be teaching market cycles. I will be breaking it down to help you understand, to give you a better understanding of how I approach the markets. Before we proceed with the class or the lectures for today, I would like to go over the key points that I made from the previous class. So from the introductory video that I did, the very first video, I'd like to go over some key points. The first key point is that, I mentioned that there is an algorithm that facilitates institutional orders And this algorithm creates, seeks, and destroys liquidity. So the algorithm needs to create, needs to seek, and needs to destroy liquidity in order to be able to facilitate institutional orders, right? That is the first key point that I made. The second is I said that price moves from buy-side liquidity to sell-side liquidity and vice versa. So price targets buy-side liquidity, sell-side liquidity, um, buy-side liquidity, buy-side liquidity, sell-side liquidity, and so on, right? And so on. So this is what I mentioned from one of the things I said from the previous lesson. That price moves from buy-side liquidity to sell-side liquidity and vice versa. So it moves from buy-side to sell-side, then sell-side to buy-side over and over and over and over and over again. Now, I also said that one of the most important thing to know is how to identify the right buy-side liquidity and the right sell-side liquidity that could potentially present a money-making opportunity or a trading opportunity, right? And I said that we can do this by counting candlesticks, right? So counting candlesticks helps us know the right buy side and sell side liquidity to mark out as our range. And I also said that we call this range from a buy side liquidity to sell side liquidity. We call this range a dealing range. A dealing range, and this range can be identified by counting candlesticks. Right? So let me go ahead to mark this out as a dealing range. So from counting candlesticks, we can identify our dealing range, right? And I also said that this dealing range, the range high and the range low, the range high is the buy side liquidity BSL, the range low is the sell side liquidity SSL. So what we do is we want to wait for price to trade above the BSL or below the SSL, right? So if price trades below the SSL of the dealing range, right, we can anticipate a reversal, a bullish reversal to the opposite liquidity, right? So now I want us to see this whole process as a cycle. The process of price creating the dealing range, the process of price sweeping one pocket of liquidity of the same dealing range, and then reversing for the opposite liquidity, right? I want us to see it as a cycle. So a cycle, market cycle, just like every other cycle, comes in phases, right? So market cycle has 3 phases. The creation, the starting, and the completion of a market cycle comes in 3 phases. And I am going to spell it out here. Okay, so for the very first phase, what happens first? So price creates a dealing range. That's the very first phase of, that's the very, very first phase of the market cycles. Price creates a dealing range. Then the second phase, price sweeps BSL or SSL of that dealing range, right? And the final phase price reverses and targets the opposite liquidity. Right? So these are the phases of the market cycle. Price first creates a dealing range. This is you can identify this by counting candlesticks, like I mentioned in the previous video, and I showed in the previous video. After price creates a dealing range, price sweeps the BSL, buy side liquidity, or the SSL. So any one can happen first. Sometimes it's depending on the higher time frame order flow or higher time frame direction, and sometimes it's just how price needs to deliver in the particular at the particular time. So price then sweeps BSL or SSL of that range. So the price sweeps the SSL, we expect a reversal to the opposite liquidity. So the final phase is when price reverses and targets the opposite liquidity. Now I want you to understand and know that there are only two types of cycles. And these are bullish cycle and bearish cycle. Okay, bullish cycle and bearish cycle. I also want us to know that price would typically start a cycle, complete it, and then start a new cycle. So when I say price would start a cycle or price would begin a cycle, what it means is price would create a dealing range, right? Then price would activate the cycle by sweeping BSL or SSL of the dealing range. So if price sweeps SSL of the dealing range, if price goes ahead to sweep the SSL of the dealing range, this activates a bullish cycle. Now, I call this a bullish cycle even when price is creating new lows, because I understand that from this point, we should expect a bullish reversal, right, to the upside. So this is the beginning of a bullish cycle. When price creates the dealing range, we already know that price is about to start a cycle, or a cycle has started already. But we don't know the type of cycle, if it is bullish or bearish. So the liquidity, the first liquidity that price targets and sweeps is what would help us determine the kind of cycle that we are in. If we are in a bullish cycle, this is when the SSL goes first, or if we are in a bearish cycle. So when price sweeps the BSL, it starts a bearish cycle. When price sweeps the SSL first, it starts a bullish cycle. All right. Now, is this always going to be the case? That is the big question. Are we always going to sell to the opposite liquidity when price activates or starts a cycle? The answer is no, right? Because imagine that we always we will always sell 100% of the time, always sell to the opposite SSL, or always buy to the BSL, then I would be so wealthy, right? I would be so rich. I would have made millions and millions and millions of dollars, even billions of dollars from the market. But this is not always the case. There are some cases where price would start a cycle, where price will sweep a BSL or SSL, but then it will fail to reach the opposite liquidity, right? There are sometimes that price might do something like this. So sometimes price will do something like this. Sweep SSL, give a little bit of reversal, and then to just keep on selling down, right? There are some times that price would sweep BSL and it won't even reverse. It just keeps on going higher and higher and higher. Now, what's the logic or the reason, some of the reasons behind this? I have 3 reasons that makes this kind of stuff, that explains why this happens, right? When price fails to complete a cycle, price starts a cycle without completing that cycle. I am going to go ahead to list the 3 factors. Number 1 is there is a hierarchical nature of market cycles. There is a hierarchical nature of market cycles. Number 2 is smart money technique. That's SMT, right? SMT is also a factor that prevents price from completing a cycle. Then we also have fundamental factors. So when I say fundamental factors, what I mean is when there is a heavy fundamentals coming in, especially for assets like gold, silver, right? When there is like heavy fundamentals coming in and we just see price moving towards one direction. So price would most likely violate or fail to respect market cycles that are in the opposite direction or opposite bias of where the fundamentals is driving price to. Okay. So let me talk about the hierarchical nature of market cycles. Now, this is indeed a broad subject, right? Because as you can see, this is the first part, the part 1. So there will be another that would further explain market cycles. So there is a hierarchical nature. There is a hierarchical behavior of these market cycles or these dealing ranges, right? Now, if you go to the 1 minute time frame, you'll be able to spot a dealing range by counting candlesticks. If you go to the 15 minutes, you'll see many dealing ranges. If you go to the 1 hour, you would also spot the dealing range. If you go to the 4 hours, daily, weekly, monthly, 3 months, 6 months, 12 months time frames, you will see dealing ranges. Now, these dealing ranges are everywhere on the charts across all time frames, right? You can find it almost everywhere. Now, this makes you wonder, will price deliver every single dealing range? Will price start every single cycle and end every single cycle? No, price won't do that, right? So when I discovered that you can identify dealing ranges and you can identify liquidity by counting candlesticks, right? It took me a very long time to be able to trade it profitably. Now, prior to discovering candlesticks, counting candlesticks, I already was trading, right? I was trading ICT concept, and I was trading ICT concept profitably. But then discovering candle counting, I wanted to incorporate it into my trading, but it was difficult for me because I just kept on trading every single dealing range. I just wanted to catch every single BSL sweep to SSL and SSL sweep to BSL. But price doesn't deliver all the time, right? Now, this made me start researching, learning, studying price until I discovered again that there is a hierarchical nature of these dealing ranges. What this means is there are some dealing ranges that the algorithm values more than others. There are some dealing ranges that the algorithm values more than others. So there are some dealing ranges that when the cycle starts or when the cycle gets activated, price would just want to complete the cycle, thereby ignoring some other dealing ranges on other time frames. Okay. And to make this simple for you to understand, the value or the level of importance of these dealing ranges increases as you go higher up the time frame, right? So the higher the time frame, the more important the dealing range to price, okay? The more important the completion of the market cycle. That is what I mean. So what this means in short is a 1 minute dealing range will not be as important to price as a 15-minute dealing range. A 15-minute dealing range will not be as important to price as a 1 hour dealing range. A 1 hour dealing range will not be as important to price as a 4 hour dealing range. A 4 hour dealing range will not be as important to price as a daily, and the daily not as important as a weekly, weekly not as important as a monthly, and so on. Okay. So getting this out of the way, right? Let me go ahead to further explain. So let's say we have this as a dealing range, or you know what? Let's say we have, let me clear this out. Okay. Yeah. So let's say we have, all right, let's say we have this as our current dealing range. Okay. Right. Let's say we have this as our current dealing range. And let's say this is a dealing range that we can find on let's say this is a dealing range that we can find on the weekly time frame. This is a 1 week dealing range. Okay. Weekly time frame. Now, this is the first phase of the cycle. Price creates a dealing range. Now, since the weekly dealing range has not been activated yet, right? So we don't know if it is going to be a bearish cycle or a bullish cycle, right? We can trade lower time frame dealing ranges inside of the weekly dealing range. Do you get it? Right? So we don't have to sit on our hands until the weekly activates. We can still trade the daily dealing range, 4 hour dealing range, 1 hour dealing range, and so on, right? So when price activates the weekly dealing range, like this, let's say price goes to the BSL first and activates the weekly dealing range. Hold on, please. Like this, price activates the weekly dealing range by starting a bearish cycle, right? Since it went for the BSL first. Now, from here, what do we expect? We expect a reversal, right? We expect price to start trading lower, reverse and start trading lower to the opposite liquidity here, the SSL here, right? Now, once this happens, to the algorithm, delivering price to the opposite liquidity becomes top priority, becomes a major objective, right? Do you understand? So delivering price to the opposite side becomes so important to the algorithm. And since the cycle is bearish on the weekly, we can say that, yeah, you can say that the order flow is bearish. You can say that the bias is bearish, right? This is how I know bias. This is how I know draw on liquidity. For those of you that always ask, how do you know this? This is how I do it, right? So I just want to know the higher time frame cycle. Are we bullish on the cycle or are we bearish, right? So since the weekly in this case is bearish, price wants to deliver to the opposite liquidity. That is the main objective. Now let's say you drop down to the 1 hour time frame while price is at this level, and we are seeing price deliver on the 1 hour time frame, right? Price is delivering on the 1 hour time frame. And let's say price then creates a dealing range on the 1 hour time frame like this, right? And this is the dealing range high, the buy side liquidity on the 1 hour time frame. Now we understand that on the weekly we are bearish and we expect price to get to the opposite liquidity, right? On the 1 hour time frame, price has created a dealing range. Now we wait for price to sweep BSL or SSL of that dealing range. Now let's say price then goes ahead to sweep the SSL of the dealing range first, the 1 hour dealing range, the SSL first, right? Now, because of the fact that the weekly, which is the higher time frame, is bearish and we expect price to go as low as this, right? We cannot trust the 1 hour cycle to complete. By completing, it means price then reverses from here and gets to the buy side liquidity, right? So since we have a bearish higher time frame cycle, then the 1 hour bullish cycle may not hold or it may not complete, right? So it may trade back into the range a bit, then keep on dropping, all right? Now let's say price then progresses lower, and then we see something like this. We see price do something like this. Then price on the same 1 hour time frame, price then creates a new dealing range. Okay, the dealing range high, the dealing range low. Okay. Yeah. So this is a new 1 hour dealing range. The previous 1 hour dealing range, price started the cycle, but price failed to complete it. And the reason is because the weekly is bearish, right? The weekly cycle is bearish. So any lower time frame opposing cycle to the higher time frame cycle would probably not work out, right? It won't complete. That is just about the hierarchical nature of market cycles. So to the algorithm, delivering the weekly cycle is the main objective, right? Now, back to what I was saying. Price creates a new dealing range. Price takes out the buy side liquidity of that dealing range. So this time it takes out BSL first. Now this activates a bearish cycle, right? Because we now expect price to reverse from here. This activates a bearish cycle on the 1 hour time frame. And since the 1 hour bearish cycle is in line with the weekly bearish cycle, we can expect this cycle that has started on the 1 hour time frame to complete or to get to the opposite liquidity. Right? So we can expect this to happen. The price would progress until it gets to the final target. So this is an idea of how I anticipate these daily ranges to work out. And something else that I would like to say. So I call the main or the highest time frame cycle, I call it the controlling cycle. Very, very important for you to notice. So I call it the controlling cycle. That's what I call it, the controlling cycle. Okay. Then I call the lower time frame cycles, right? I call them the sub cycles. So this one here and this one here, right? Yeah, so this one and this one, I call them the sub cycles. Sorry. So I call them sub cycles. Okay. So the logic behind trading market cycles is we want to identify the controlling cycle, right? We want to identify the controlling cycle. And you do this by going to the highest time frame that you can find an active cycle, bullish or bearish, right? So this gives you an idea of bias, an idea of order flow, right? And what you go to the lower time frame to do is to look for sub cycles that are in line with the higher time frame controlling cycle. Okay. I'll say it again. You want to go to the highest time frame. It could be the daily, the weekly, the monthly, highest time frame that you can see an active cycle. So a cycle that has already defined itself as either a bullish cycle or bearish cycle. So a cycle that has activated the second phase, right? So it has swept the buy side or the sell side. So once you see this, you know to expect price to reverse, right? Or turn around, reverse. So after identifying the highest time frame cycle, this would be your controlling cycle. It is your controlling cycle because it controls the direction of price. The sub-cycles do not control the direction. The sub-cycles just gives us entry, right? Because we want to enter above BSL if we're bearish, above sub-cycles BSL if we're bearish, and below sub-cycles SSL if we are bullish, right? So controlling cycle gives us the direction, gives us the bias, it gives us the order flow, right? Then the sub-cycles gives us entry. So we want to trade every sub-cycle that is in line with the higher time frame controlling cycle, right? I really hope this makes sense. It makes sense to me, right? But that is not what is important, right? What's important is my ability to pass the information to you for you to understand. Okay, so that is how I approach it. Now, this is what I want you to do after watching this video. You can watch this video as many times as possible, right? You are not being charged for it. You can watch it as many times as possible, as many times as necessary until you understand what I am saying and the information in this class. I want you to understand it. And once you are done, I want you to go to your charts. Now, for the sake of understanding this, I'd like us to just stick to, GBP USD and Euro USD. Okay. This approach works on every asset and every time frame, right? But I would like us to just stick to Euro USD and GBP USD. There is a reason why I am saying it, okay? As a beginner, as a newbie, as someone that is just learning this, your learning process would be a lot easier if you can narrow down the number of pairs that you look at, and you just look at, very volatile and very, very common pairs like Euro USD and GBP USD. Okay, so I want you to go to either GBP USD or Euro USD chart, go to the higher time frame, and I want you to identify a controlling cycle, right? A controlling cycle that has already completed, right? That has been activated and also completed. So a complete controlling cycle. It could be from the daily, the weekly, the monthly, right? So once you see that, mark out the BSL, mark out the SSL. Now, after marking out the SSL and BSL, I want you to go to the lower time frame. So you can now drop down to the 4-hour, 2-hour, 1 hour, 15 minutes. And I want you to pay attention to how price delivers towards the direction of the controlling cycle. I want you to do this with as many examples as you can find on the chart. And I also want you to study, because this simple act or this simple exercise, right, it would help you a lot to be able to see that, in fact, what I am saying is true. That is the first. It would give you more confidence in my teachings, and it would also help you understand this concept better, right? So to repeat what I said, what I want you to do now is go to your charts on GBP USD or Euro USD. I want you to go over, try to identify a controlling cycle from the daily, weekly, or the monthly time frame. A controlling cycle that has already delivered, right? That has started and completed its cycle. So you mark out the buy side, the sell side. Now you drop down to the 4-hour time frame. You can drop down to the daily 4-hour time frame, 2 hours, 1 hour. So what you are doing on the lower time frame is to study the delivery of price. Study how price creates sub-cycles. Study how price creates sub-cycles and how price violates sub-cycles that are not in alignment to the controlling cycle. Watch how price respects sub-cycles that are in alignment to the controlling cycle. That is what I want you to do for me. So this is where we'll close the curtains for now. This is the part 1. In the part 2, I would be explaining market cycles in a much more deeper level. So I hope this was insightful. Please do not forget to like, share, subscribe to the channel. And one more thing before I end. I am going to be attaching my Telegram link to the link to my Telegram channel, to this video, to the description of this video, and you can go over the contents that I share in my Telegram channel, because what I post there is I post DOLs, and I also post the trades that I have taken using this same concept. So you can study my previous trades, my previous winning trades that I've posted on the Telegram channel. You can study that, and it would help you build this muscle memory to be able to identify candle counting and market cycles as well, right? To just help you understand my concepts better, okay? If you also want to connect with me, I would try to put the link to my WhatsApp if you wish to connect with me, right? So I'll do that as well. I hope you found this video or this lecture insightful. Remember to like, share, subscribe, and I would see you in the next one.